Now, let's turn to what unfolded in China's silver market. At the opening bell in Shanghai, silver futures began trading at $99 per ounce, while the Western spot silver was sitting near $88.50. This gap did not emerge unexpectedly. In the previous update, we discussed strong real-world physical buying demand coming from Shenzhen recyclers, where bids were running about $5 or more above the Shanghai futures. Exchanges pre-holiday close. That activity was not random market noise. It showed how physical buyers were already pricing silver before trading officially resumed. As the session progressed, Shanghai silver climbed to $102 per ounce before closing at $96. One detail deserves attention. Although the session average settled at $96, reports suggest the final physical lot traded at $102. There is reasonable debate over whether the average price or the final transaction better represents actual demand, but both figures remain well above Western spot levels. That difference is important. With Western spot now around $86, Shanghai's closing price reflects roughly a $10 premium. At the same time, trading activity in Western markets during Shanghai hours was notably light. Low volume combined with strong premiums and elevated physical bids points to a deeper market disconnect rather than a temporary imbalance. For short-term chart observers, this discussion is purely educational and not financial advice. Recent analysis identified a resistance range between 87.20 and 89. Price has tested and rejected this zone 3 separate times without producing a decisive hourly close above it. Western spot currently trades near 86.40, once again below that resistance level. Until a strong hourly candle body, meaning a full close above the level, not just a brief spike, closes above 89, the resistance zone remains valid. Looking at broader market conditions, the COMEX implied volatility index for silver options, a measure of expected price movement, has risen sharply to 134. In the previous update, it had only just crossed above 100. The current reading exceeds levels recorded on January 30th, when silver briefly surged to $120. Such elevated volatility readings are highly unusual and suggest that options markets are preparing for potentially large and disorderly price movements not yet reflected in spot pricing. Both the SLV volatility index and silver futures options are signaling heightened upside risk. In simple terms, prices appear relatively contained while volatility expectations continue, rising, a divergence that historically does not last forever. Meanwhile, the Shanghai Futures Exchange took regulatory action by suspending another group of trading accounts for violating exchange rules. This raises the total number of suspended accounts in February alone to 23. Significant manipulation attempts were observed during the SHFE opening session and tracked in real time through order flow monitoring, which tracks real-time buying and selling activity. The exchange's response confirms these irregularities were serious enough to require intervention. Focus now shifts to settlement conditions, where pressure appears most concentrated. March open interest currently stands at 37,651 contracts, representing approximately 188 million ounces of paper silver, approaching settlement within 3 trading days. Registered. COMEX silver, metal officially approved and available for delivery, totals about 88 million ounces. That creates roughly a 2-to-1 ratio of paper claims compared to deliverable physical supply. The rollover into May contracts is underway, with open interest increasing as traders move positions forward. However, the process is not happening quickly enough to completely ease delivery pressure. February 26 marks the final practical day to roll March futures positions to avoid delivery exposure, while February 27th begins first notice day, when delivery notices can begin and remaining long holders face assignment risk. Importantly, registered silver inventories have remained flat to slightly lower in recent sessions. There has been no meaningful inflow of new metal into COMEX vaults to replenish available supply. Another closely monitored signal is the carry-adjusted price difference between March and May futures. Markets are watching to see whether this spread transitions from contango into backwardation. Under normal conditions, future contracts trade at a premium to spot prices due to financing and storage costs, a structure known as contango. If nearby contracts begin trading at a premium instead, creating backwardation, it signals urgent demand for physical metal regardless of paper pricing. Backwardation has not yet been confirmed, but such a shift would significantly change how markets view the situation. Author Jim Rickards has described physical commodity stress as the point at which underlying financial tensions become visible, when paper pricing systems begin to strain under real-world demand. The current divergence between Shanghai prices near $96 and COMEX pricing around $86 resembles that dynamic unfolding in real time. Looking at the bigger picture, geopolitical factors add another layer of complexity. Crude oil has risen to $67 per barrel, its highest level since August, alongside increasing bets on higher prices. Commodity markets are now questioning whether traders are positioning ahead of potential escalation involving Iran. At the same time, global oil discoveries have declined sharply, falling about 40% over the past decade, from an average of 10 billion barrels annually between 2015 and 2020 to roughly 6 billion between 2021 and 2025. Because new exploration projects typically require around 20 years before production begins, this creates a long-term supply problem. Rising oil prices, driven by both geopolitical risks and supply constraints, add additional inflationary pressure into a macro environment already supporting gold and silver. Recent import data from India confirms another record month for gold purchases, reinforcing an ongoing trend rather than a one-time event. Physical demand across Eastern markets has remained historically strong for months. While Western financial media often attributes gold's rise to momentum trading, many analysts lack a framework explaining why spot gold is trading near 530. Some describe it as a bubble or speculative excess. Yet institutional and sovereign buyers across Asia appear to be reallocating capital based on long-term assessments of value. Data from the World Gold Council, Indian import statistics, and Chinese ETF flows all point towards sustained structural demand, even as mainstream narratives struggle to fully interpret the shift. That said, caution remains necessary. The Shanghai session itself demonstrated volatility. Silver opened at $99, surged to $102, and ultimately settled at $96, failing to hold above the $100 level. This suggests genuine selling pressure as participants take profits or reduce exposure at higher prices. Elevated implied volatility also introduces downside risk. The same conditions that allow rapid upward moves can produce sharp declines if coordinated intervention, margin pressure, or a broader market sell-off forces liquidation across markets. Additionally, the price difference between Shanghai at $96 and Western spot at $86 does not automatically mean Western prices must rise. Convergence could also occur if Shanghai prices move lower should physical demand weaken. Market technician Humphrey Neal once observed that price action tells you what is happening, not when it will finish happening. Structural trends are revealed through data, while timing remains determined by the market itself. Here is what current data shows. Shanghai closed at $96, maintaining roughly a $10 premium over Western spot, with the final physical trade at $102. COMEX implied volatility stands at 134, the highest level since January's spike. Approximately 188 million ounces of paper silver approach settlement against 88 million ounces of deliverable supply. COMEX vault inventories are not being replenished. India continues to record strong gold imports. The SHFE has suspended 23 trading accounts in a single month for rule violations. The March-May spread is approaching a potential backwardation signal. Western spot silver remains near $86.40 after 3 failed attempts to break resistance. In summary, paper pricing and physical market signals are telling different stories, a divergence that has persisted for weeks. Eventually, that gap will resolve. Whether that happens this week, this month, or over a longer time frame remains uncertain, but the direction of structural pressure appears clear. Investors should independently verify CME volatility data, review COMEX reports, and analyze open interest figures. The most common mistake is not misunderstanding data, but interpreting accurate information through biased expectations. This discussion is intended for market education, not investment advice. Protect your capital, manage emotions alongside positions, and remain disciplined during periods of volatility. Those who combine objective analysis with emotional control are typically the ones still standing once market turbulence subsides. Always conduct your own research and make decisions based on logic rather than hype.